Okay, so good evening, everyone, and welcome to Alma's monthly webisode series. My name is Maulik Shah, and I'm one of the co-founder and a CEO of Alma's Risk Consulting. And this is the ninth webisode series. We started in April 2023, and every month we have this series. Uh, at Almas, we are specialized in managing currency, commodity, and interest rate risks for the clients. And every month through this webinar series, our endeavor has been to spread knowledge, create the different topics which are relevant for the markets and the market participants, and in the process, empower and enable you in your decision making process. So that has been our efforts. And today is we are in the month of December, and this is 2023. When we look back, this is the last month of the calendar year, and we are stepping into 2024. And we thought, why don't we really have a look at what really has happened? And as we step in 2024, which are the major emerging trends? And with that thought in mind, we picked up this topic. And when we really look at entire year 2023 and even the previous year, a lot has happened. And when I say a lot has happened, maybe for the finance professionals, for the market participants, there are a number of events which were beyond the realm of imagination. There are some events, some risks which you will foresee, you will manage it, you will preempt. But there are some events which unfolded, and I'm also referring to geopolitics, whether it is a Ukraine war or Israel attack, all of that was beyond the realm of imagination. And that really puts the question back into the boardroom as to, how are you going to manage the risks which are known, risks which are known but unknown. I don't know how I'm going to manage, but there are certain risks which are unknown. How do we prepare ourselves? And with that as a question mark, not many will be able to even answer that question. We thought probably it may be a prudent for us to really pip in what probably could be in front of us as we step in 2024. And with that context, we picked up even the speaker who probably is in the best position to even give an overview with his rich experience, his expertise in the financial market. And when I say financial market, I'm referring to fixed income, the currencies, the commodities. He is the authority, he is the experts. And with him, Mr. Gopikrishnan, whom I'm referring to, and our own Jayaram Krishnamurthy, who is one of the co-founder and the head of research and advisory, we thought this could be the best team that we can really put forward for our participants. So I take pleasure, firstly, in welcoming all of you and also the speakers for the session. All of you, I know a lot of you, I'm seeing, being a regular attendees of the participants, of the webinar webisode series. And I really appreciate your participation, because your participation encourages us at Almas to come back with this monthly series with a lot of enthusiasm. So thank you all very much for taking your time and being here today on the webinar series. And let me now introduce our speakers for the session. I take immense pleasure and a pride also to introduce Mr. Gopikrishnan. He has been a finance professional expert for the last more than, I think, 2 decades. He started his career with IDBI Group, where he set up the primary dealership business and grew it to the top rated PD in the country within a very short period of time. He ran the currencies and rates business in Deutsche Bank for almost 8 years before moving to Standard Chartered Bank, where he joined as the head of macro trading for South Asia and grew over the years to head the financial market division for South Asia. Currently, he acts as a financial and business advisor to boutique fund houses, banks, family offices, startups. He's a member of SEBI Hybrid Security Advisory Committee and Committee for the Review of Financial Stress Indices. He's a well-known face in the financial market. He comes very regularly on CNBC. He has been a very active player, influencing policy decisions with respect to markets by closely interacting with policymakers like RBI, SEBI, MOF. He was a vice chairman of FEDI, and he was also a board member of FIMDA. He is passionate about market integrity and ethical behavior, people, and innovations. Welcome, Mr. Gopikrishnan. And we have with us Mr. Jayaram Krishnamurthy, who definitely, for most of you, does not require his introduction. Been in the market, even I know age is just a number, but still at this age, his commitment for the market is immense. I mean, he still gets up at 4:35 in the morning. You will find him at 12:30 last night updating on the FOMC. Been with the banking industry and with Almas as a co-founding partner. It's my pleasure to have him on this call, sharing his wisdom and expertise on this panel session. So,
Thank you,
Jayaram,
Maulik.
welcome once again.
Thank you, Maulik. Hope we'll be able to give something to the participants.
I'm sure they will take the immense value of your insights. So let me begin the session by inviting first Mr. Gopikrishnan. While I already created the background about outlook for 2024, and over to you with your opening remarks, and then Jayaram can share his piece. Yes, over to you, Mr. Gopikrishnan.
Yeah, thanks a lot, Maulik. Thanks a lot, Almas, for having me in the session. As Maulik put it, it's one of the most difficult things to do, which is predicting the outlook for a year ahead, especially given that 4 years has been pretty active in terms of events. We had pandemic, then we had Russian crisis, Russian-Ukraine conflict, and then Hamas attacking Israel and the backlash on Hamas. And here we are in the situation where we are trying to understand what events could unfold in 2024 and how markets will look given what information we have today. It's very difficult to predict, as Maulik said, unknown, known, unknown, and of course, unknown unknowns. So there's too many unknowns, and I'm sure if there was a conference, I'm sure there were a few conferences last year as well as on Outlook. I don't think anybody would have predicted a Israel-Hamas conflict. So here we are sitting and trying to understand what could happen in 2024, but given the information we have today. So the predictable stuff like geopolitical conflict is always on the table, and it's not something which we can play for. And that is something which we need to dynamically look at. Given this background, I think let me first of all tell you that I come from a business family. I'm a black sheep. I never worked in never did a business as such. But I have immense respect for entrepreneurs, and I hear a lot of entrepreneurs here who are watching this conference. I have a lot of respect for you. Your contribution to the country is actually under appreciated in my view. Thanks a lot for everything. So with that, let me try and say a few things on what I think could, happen in 2024, especially for INR, for rates market in India and globally, and also to some extent what we can expect on the equities side. So equities, I'm not an expert in equities, but I'm a passionate equity investor and trader. So to that extent, I have some knowledge and I keep tracking markets quite closely, but try and give you some insights into what I think could happen in equities in 2024. So when we talk about what is happening last 3-4 years, I think a big picture to me is we had a large economy, the economy which was driving everything in the world, which was US on one side, and we had China on the other side pushing exports and being the manufacturing hub for the world. When they were manufacturing hub, they were actually manufacturing low cost, cheap materials, stuff like that. But what has happened since the conflict, since the pandemic and the conflicts which ensued after the pandemic is that we had the US bringing an embargo or a sanction on Russian exports. And then they also simultaneously started asking the manufacturers to move their production in China to other countries which are more friendly. It's called friendshoring, and things like that happen. But trade is like water. It will flow through the fastest route and the cheapest, most efficient route. When these kind of blockages happen, trade will definitely find other routes to reach the end users. And that's what I think is happening currently. So you had China being blocked, but see what happens? China starts exporting. They actually moved up the value chain. They are now today exporting a lot more capital goods, a lot more cars. I mean, China has emerged as the largest exporter of cars. I don't think many people closely watch that. And they become largest exporters of cars. And who are they selling to? They're not selling to the US or the Europe. They're actually selling to within Asia, to ASEAN countries, and to South American and African countries. So just to give us a number here, to give perspective, ASEAN exports of China used to be 60% of its exports to US. So if US exports were 100, China exports to ASEAN used to be 60. Today, the number is 120, which means it has basically increased over what they are exporting to US. So clearly, China has found new buyers for its exports. Two, they are obviously going up the value chain. And that is the story on one side. The other thing which happened was sanctions on Russia. See, we all know what happened. Russia started selling oil to other countries. So Indian oil imports from Russia from nearly zero, it's now at 40% of our requirement. So clearly oil has found its way and Russia has found buyers to sell its oil and in currencies which it is accepting from the buying countries. So this is what I was talking about trade. Clearly the balance of power in the trade is clearly moving from the West to more towards East and Russia. So this is the big picture which is happening, and it is an emerging story. And I think this is the biggest thing which will happen next decade. De-dollarization and stuff like that are linked to that, but this is what is actually happening in the trade side. Now going back, this is more a long-term picture. Going back to what we think for 2025, we have to start from again the largest economy in the world, which is US. US, like every other country, went through a cycle of high interest rates, high inflation. Because of that, FOMC had to hike rates. They hiked rates by 5.25%. Now, markets were expecting them to cut rates this year because they were expecting recession. But what happened today, end of 2023, we see still growth happening in the US, maybe at low rate of 2%, but still it's growth. It is not recession. But we have come to a situation where there is a potential slowdown and potential fall in growth on one side. And then inflation, which was the biggest worry for Fed and others globally, is also showing signs of coming down. And this is what I mentioned about the trade finding its new way. So when trade gets a new way, it eventually goes to the buyers. And slowly we are seeing that impact of the disruption which happened in 2021-22 is basically getting unwound. And we are seeing that impact having on the inflation. So given this background, yesterday we had the FOMC where they clearly mentioned that they're looking at slowdown in growth. And they have moved their dots to say there'll be 3 cuts in 2024. It's a different thing. Markets are expecting 5 cuts and further cuts in 2025. Personally, I feel market is not wrong this time. Maybe they were wrong last time, but I think there'll be cuts. And I feel that inflation is definitely on the lower side and it's going to come down. It's going to surprise on the lower side. Growth is not that a big concern to me as much as inflation falling. So which means it augurs well for rate cuts. So I do expect 125 basis points cuts in 2024 from the US. Now, the only worry I think for US would be the large fiscal deficit. I think that is something which is concerning them. 38 trillion of government debt, which is outstanding, which is like 130% of GDP, which is one of the highest, and it's increasing for the country. So that is the biggest concern which US should have. And that itself will be a big player, big reason for dollar to have some weakening bias going forward, apart from the rate cuts. Now, if we move from US to the next largest, or let's say next large pack, which we look at, is the European Union. The story is very different in the Europe from the US. Growth is hardly anything. Growth is at 0.2%. Or 0.1% latest print, but I expect the growth to pick up a little bit, maybe 0.2, 0.3 for the rest of the year. In 2024, the European Commission is expecting a 1.2, 1.3 kind of growth, which many of the commentators think it is on the higher side. So growth is definitely impacted. And what is impacting growth per se? Basically, inflation, infused interest rate hikes, which has reduced consumption demand locally, and also fall in exports. When you see fall in exports, it is not just the fall in demand globally. It is basically also fall in demand for products out of Europe. And one of the major reasons, in my view, again, is China emerging as large exporter of capital goods and vehicles, and also Japan suddenly becoming an important player in the whole scheme of things. And why I think Japan is becoming important? In a way, Japan and Europe are direct competitors for exports, especially machines and automobile. And what has happened? Since the COVID hit, Euro has actually depreciated 25% against Japanese yen. This 25% is a massive disadvantage for Eurozone. And that is a big reason why I think Europe is facing a lot of pressure in terms of export growth. So these two factors have contributed to a low GDP number. Inflation is coming down. Inflation score has come down to a level where the European Commission is kind of comfortable. So I don't think inflation is a big worry for them. One thing which I need to highlight as a comparison between US and Europe is what we call as unit labor cost. In the US, while labor cost has gone up, productivity gains have been massive. So as a unit labor cost has fallen. So that is a massive advantage for US. So that is why we can't write off US in a hurry. US is going to be a dominant player for at least a decade or so. Same parameter, same look at the same number in Europe. Actually, there has been wage increase, plus there has been productivity fall. So both these have contributed to a huge increase in unit labor cost. And it is more predominantly seen in services. And in services happen to be 60% of the core CPI, which the European Union European Commission looks at. To that extent, I think the inflation could be sticky in the Eurozone, unlike what I expect in the US. But there is definitely a downward bias for inflation, which gives an opportunity for European Commission to cut rates. As we talk, I think the European Commission, the meeting is happening. I think they will look to cut, at least indicate that they look to cut 3 times next year, which basically means 0.75%. I think maybe 100 basis points cut could come next year. Now, I think it could be higher than what they are anticipating. Markets are anticipating 1.25%. The reason why I'm not anticipating is basically coming from the stickiness from the higher unit labor cost in the Eurozone. So that's where as far as Europe is concerned. Moving to the other big country, which is China. We just discussed about China briefly in the start. China is clearly slowing down. We all know that it is 5.5%, and there is an expectation it will grow at 4.5 to 5%. Is the government there worried? It doesn't seem to be worried at all. Government seems to be focused on converting the country into high technology-based production, manufacturing hub for the globe, rather than being the low, cheap cost production, which they focused over last 25, 30 years. So clearly they are focused with something which they want to achieve over a long term. And my firm belief as far as China is concerned is they look at centuries, the way we look at decades. They don't look at decades. They never give a projection for 2030, 35. They always talk about what they want to be in 2100, things like that. They really talk long term. And that is something which clearly is there in their focus. When you focus for something over next 30, 40 years, there'll be a lot of sacrifices which you need to do in the short term. And I think the sacrifice they're making is a short-term growth sacrifice. Basically, housing property growth has stumbled. It's fallen like crazy. And I don't think they're even worried about it, or they're doing anything more than lip service. They are trying to make some changes, but it's more look like lip service, but the focus is still on the longer and big picture, which they're talking about. So given that, I think China will be least of the problems in terms of, or rather China will see a lower growth, and it will continue to see lower inflation. But they are going to be a dominant player in global market, in global trade. And I'm super bullish China, but not for 2024. Let's write off China for 2024. And let's not worry about that for now. Now, these are the 3 large economies. We touched upon Japan and the competitiveness Japanese yen as over all currencies. If you see Japanese yen against even the other Asian currencies, they have fallen like 9 pins. So clearly, Japan is not worried about anything. They just want a currency to be weak. And you know what? There's something called blue zones globally. Blue zones are areas where human beings live for more than 100 years, 120 years. So some of them are there, interestingly, in Japan. And the average age is 92 or 93 years. And you have people over 100, a lot of them living there very happily. Amongst other reasons, I think not worrying about price rise is one of the major reasons, I think. So that's as far as Japan is concerned. Now coming to our own country, everything is rosy around. GDP printed a big number, which is more than expected. RBI governor came 1 week early and said that it will surprise everyone beyond expectations. And he actually gave us that expectation going to be very high, and it turned out to be very high. We had a 7.6% print as against a range of 6.5 to 6.6 kind of an expectation. That is whole 1 point increase. This has prompted them to increase the 2023-24 growth projection to 7% from earlier 6.5%. That's a massive jump. And they are also projecting around 6.5% roughly for next year. Now, if you see the GDP growth in India, I'm sure Jayaram will touch upon it later on. The growth is predominantly coming from capital expenditure, and that too within capital expenditure coming from government spending. Private consumption and private investments is slow down. It is positive and negative. Positive because overall GCFs, which is capital formation, has been pretty high. It's at 32-33% of GDP. This is at an all-time high, which really very well augurs well for the future of the country. However, unfortunately, most of it is coming from the government sector. And why I think that is a negative? Because we are at 5.9%, or rather, we are targeting 5.9% as fiscal deficit for 2023-24. And with an expectation or a target of 4.5% by 2026, the headroom for government expenditure is going to come down. And if they have to achieve that, revenue expenditure is very sticky, as we all know. They cannot cut salaries, they cannot let go people, or they cannot let go subsidies, which they are currently doing. So revenue expenditure is going to be very difficult to control. The only expenditure they can have control on is capital expenditure. Unfortunately, there is possibility that they will have little headroom for putting the increase in the capital expenditure any further. In fact, the absolute number could be stable, which itself is bad news. The only hope is private sector sees all these benefits of investment in infrastructure, whatever they do, the government does in this year, and potentially look to put investment into the businesses. So that is one area of concern for me in the GDP. On the inflation front, everything looks rosy again. In fact, I'm even more, as I said, inflation is something I've been very positive across the globe. And in India, I'm very, very positive. Yes, headline inflation is very volatile. We have had a 5.5, we had a 6% kind of prints. And most of it is coming from wage prices and pulses and cereals. Food inflation is something which is very difficult to handle, right? We had a erratic monsoon, and the impact is seen today. Government is trying its level best to put restrictions on exports, trying to release cereals, try to actively manage. This government, India, for example, has been very actively managing inflation from their side by releasing food grains or putting restrictions on exports or even importing times to control inflation. So I have faith in that process, and I think this will be contained. Now, moving further, which is the sticky part of inflation, like we spoke about sticky everywhere, it's the core inflation, which is the stickiest part. When we say sticky, what we mean is it is less volatile. If it goes higher, it stays higher. If it goes lower, it stays lower. Good for us is that it has come down. It has been coming down, and the trajectory seems to push it further down. So we had a 4.3% print in October. The last print in November has come at 4.1. The trend is clearly low. That is the overall core inflation. If I dig a little bit further in, within the sticky core inflation, there is even more a stickier portion, which is services core inflation. That is something even more sticky. And that has come to 3.6%, which is even lower than what we have seen in very good low inflation years pre-pandemic. So clearly the inflation, core inflation is low, and the service inflation is very, very low. Now there are people, including me, who are suspicious about this, especially the services inflation, given that rent inflation has been double digit. I've seen myself in some places where I look at trends closely. Nevertheless, we'll give the benefit of doubt. And I think inflation is definitely on downward trajectory. So these are the two important things which, basically influences rate actions. But the third one, which is even more important and which is very relevant to this August crowd, is the trade balance and how the deficit is being funded. So the trade deficit for October came as a shocker at 31-32, basically coming from gold, increasing gold imports and oil prices being high. That has pushed it. But seeing the reserve number, I think the reserve is close to 590 if I remove the forwards book of RBI. I feel that even this month, or rather the month just passed away, the number would have been very high. So my fear, though the expectation is 24, 25, my fear is still could have been 27, 28 for the month of November. The numbers are awaited, I think, a couple of days. Tomorrow, maybe they will release the number. But that is as far as the deficit is concerned. If I look at the funding of, so the CAD, I'm putting a CAD number at $50 billion for the year 2024, which is this financial year. And I think the trend could continue over next 12 months into end 2024. And if I look at the flows to fund the current account deficit, see, one good thing about this is services exports has increased. I'm sure it is there on the paper everywhere. It has slowed down, but it's still higher than what we have seen, let's say 2-3 years back. Now, coming to the funding part of it, we usually have FDI flows, then we have FPI flows. This is foreign portfolio flows. And finally, you'll have debt and related deposits and stuff like that. The third part has been stable. In fact, has been increasing. The deposits have been increasing marginally. What has been worrying is the FDI part. We used to have in good years of 45 to 50 billion net FDI inflows into the country. This year, it has been really low. And it looks like it probably will not even cross 20 billion if this trend continues. But I'm hopeful with all the infrastructure investment and with dollar, basically the rate cuts in the US, we probably will start seeing FDI picking up next year. But what has compensated for the fall in FDI has been the FPI flow. We have seen 26 billion already coming through, and I expect it to be around 40-45 billion by end of this financial year. And you all know that there is bond is being included into the bond index, which is expected to bring roughly 25 to 30 billion, which will start. I think the flows already started in anticipation of that inclusion. That will add another 25-30 billion. So that takes care of a lot of funding which is required. So this is as far as the funding of deficit is concerned. So one, we have a good GDP number and expected to grow. The risk of private not coming in and government not able to spend is still remaining. Inflation is clearly low, especially CPI core, CPI services core lower, giving a lot of comfort. And finally, the trade deficit is growing and current account deficit is also growing, but it is not something which we cannot handle. 8 to 8.5 months of import cover we have, and also it's one time or external debt, which is a reasonably comfortable position. Now, given that, where do you expect all the markets to go? So let's start from the US. Let me quickly finish. US, we expect rate cuts. So I expect dollar to be under pressure, but dollar will be under pressure against Asian currencies. Okay, so I expect dollar to be better off against euro or sterling for the matter, and which means that euro sterling against Asians should obviously fall more. And I see the interplay between Japan and euro. So I expect euro cuts to basically push euro down and euro Japanese yen to fall. That is on the other view. As far as dollar rupee is concerned, we know RBI is closely managing the FX, which according to me is not the right thing to do, but they are managing it. I don't expect big, rally in rupee. There are general expectation rupee will appreciate because of what's happening globally. But I expect rupee to be stable. To a little bias for appreciation, but with RBI stepping in and trying to buy it out, I don't think that's going to be a big gain. So I would put a number of close to 80 to 50 on the lower side in terms of dollar rupee, and probably 84, which is on the higher side, but I think 84 is the cap. And this can play out differently before elections, post elections. Those are things we can have it for question and answer sessions in case people have questions. Okay, interest rates. I expect RBI to cut rates because of the expectation that inflation is going down, and with the central banks across cutting rates. I think they're going to cut rates, but I think the rates cut could be shallower, probably 50 basis points. If you're lucky, maybe 75 basis points. Just not in 2024. I think for some time to come, they will stay there because they want to keep the headline inflation below 4 consistently. Even in their projection for 2025-24, they have not given anything below 4. So clearly, they are not going to rush into cuts. So because of this differential widening, we could potentially have some appreciation rupee, but what the interplay of flows and stuff can impact. And finally, just on the equity view, because the government has been pushing the growth, a lot of government companies are getting a lot of businesses. And we are seeing a lot of PSU performing well. And the whole rally in this last 12 months has been driven by public sector banks because of better balance sheets and PSUs because of better business opportunities. I think equity has another upside of 4 to 5%, but I think we are entering to a stage where we will stabilize. And with that, I probably will end the session.
Excellent, Mr. Gopi. I think you covered the various markets, and I'll just quickly sum up everything that you said. You talked about a US which is a moderate growth and an inflation which is under control, looks like. Europe, low growth and maybe a stickiness in the inflation. And all of that is going to impact the interest rate guidance further. China, maybe moving forward, it could be shaping up well, but at least in the short term, you're seeing a slowdown. And there could be a sacrifices, which means 2024 could be under pressure as far as China is concerned. But though you are bullish from a medium to long-term perspective. And when you said long-term for China, it is centuries. That's what you indicated. Japan, relatively doing well because of sheer competitiveness that you talked about, and which is for all of us who witnessed 25% currency weakness. It's significant. Coming to India, moderate to higher growth, driven by the capex, government capex, inflation under control, and the macros are fairly okay. I mean, we have a deficit, but that's well financed. So nothing to really worry as far as India macros are concerned. And you gave a guidance of the overall currency. So that's great. I have a couple of questions. I will take it up. In the meantime, let's hear from Jayaram. Your view, and also Jayaram, if you can also talk about the commodity space in general, and apart from what you intend to give as your guidance for 2024.
Yeah. Thank you, Maulik. Thank you, Gopi, for that very broad view and also perspective. You really made my job quite easy because I don't have to touch upon many of the things. Okay, a few things which I would like to add to what you have said. We have elections in many countries. US is going to face an election in November next. UK is going to an election. India, obviously, we know that election is ahead just in 3 months from now it will start. And also possibly Japan also goes into an election next year. So all these political developments will have some influence, and the major influence that I see from these political events ahead is on the fiscal. Because while inflation is coming down due to monetary policies and also control on the supply chains, fiscal spending is going to really ensure that the inflation does not fall off too much. I don't see from current levels where it has fallen to in US or perhaps fallen to in the Europe, inflation going down too much. Therefore, I would think that policy will have to be pivoted based on the inflations remaining at these levels. Then, of course, as a comparison to major economies, as we all know, US is still doing much better than major economies. Like in Europe, the two major economies like France and Germany, they are in negative growth. The US is still showing good growth. Even if you forget the 5.2% that we saw for Q3, which is backward looking, and since then there's been a lot of changes after the interest rate hikes and consumptions slowly coming down. Still, even going by the most conservative estimate by the Atlanta Fed, the growth will be closer to 1.5 to 2%, which is still better. We saw UK number yesterday at minus 0.3%. So clearly, and Japan also. So clearly, US is still leading as far as the growth picture is concerned. No wonder we have to follow what's happening in US, not just because of the monetary policies that they are pursuing and the flows that it will entail, but also because the growth picture in the US, because that is a market for everyone. So that is one. But dollar still despite these things, dollar is still probably headed lower in my view against most currencies because it is underowned. We have had a dollar rally starting in 2011, and we still not too far away from where we were. Not too far away from the top. So we have scope. And as Gopi said, I think EMs are going to get much better advantage out of the dollar's weakness, mainly because of the rate cuts. So like in India, I had to repeat what Gopi said, that the FTAs have been really disappointing. And FII flows have been very good, almost making up for the outflows that we had in 2021 and 2022. And that's really good news. But FDIs, for example, from April till September, we had net FDI of about 10 billion, which is comparable to 20 billion last year. And that's really disappointing as far as India is concerned. But the silver lining is that the recent event of the state elections, which probably many are seeing as a harbinger of stable government for one more term at the center. I think many of the people who are sitting on the say on the walls, they might actually now think of a stable policy, and continuation of the policies already in place, reforms in place. So I think long-term investments into India may just pick up. I think it's around the corner. Maybe the last 3 months of the fiscal year, we might see some more good inflows, but may not touch the 45-50 average per annum that we used to get. That is probably not going to happen. And as far as trade is concerned, yes, it is definitely a concern that I think unless we see these large flows, the pressure will be there, and any strength in the INR is not going to be sustainable unless we see very large flows. And of course, the bond-related flows will be a relief. Again, how much of it RBI will absorb and how much they will allow the rupee to reflect the flows is something that we really have to wait and see. So given this background, I have a couple of few things to share as far as what can happen in 2024. Just a second. Yeah, so I have my own one second. Can you see my screen fully? Yeah. So,
Yes.
so my own observation is that history says that we have a financial event or a market event in every 2 or 3 years as the market gets into excesses, and we know that equities have been rallying one way almost, and we did have in between corrections, but we are still Dow hit all-time high yesterday. India keeps hitting all-time new highs every other day, and I wouldn't call it too much exuberant, but then I think valuations, there are people who say valuations are not justified considering where the interest rates are now. And if you look at the PE in US, at this interest rate earlier, the PE used to be 15 and now it is at 18. That is where I feel it is excess. And also one more factor about US is that a lot of valuation or the money has gone into limited sector, particularly in the internet and the AI sector, and the broader market is not actually seen that much of a gain compared to these sectors. So there is a skewness in the rally. So these are bound to get corrected. And as I have seen, these events do keep repeating, and market excesses are corrected. So huge interest rate hike of 5.25% by the Fed will definitely have a sharp and lag effect on the economy. I feel the Fed, by announcing suddenly a pivot next year of 0.75%, while till recently they were pushing back against the market's expectation of even 1%, gives me a feeling that Fed is probably seeing something more on the downside for the economy. That's probably why they are, now ready to pivot. I've never seen a statement from a Fed chairman that we have seen the peak in the rates. I don't think we'll see a hike in the rate again. So that was a very clear statement from him. So that's what I feel as far as the US economy is concerned. I don't know where the market correction or market event will come. There are some possibilities. If you look at the indicators from the US Beach Book or the consumer confidence, some of the forward-looking indicators, consumer confidence, the leading economic indicators, manufacturing ISM is on contraction for the last 12 months. There are some pointers. And I think the vulnerability mostly is in the banking sector, which, particularly on the mid-sized banks. And we also already had one episode last year of some banks failing because of the mismatch in their assets and liabilities. And, while Fed has helped them by giving them liquidity support, I think those losses are in their books, and it has to show up when we see the results and how they will look. How the health of the bank will look like when they come out with the year-end results. So that is something, banking sector. And then the housing, what we have seen in the housing is that the affordability of the housing is at one of the least and one of the lowest levels, while the housing prices are at one of the highest levels. So that's a very big divergence that we are seeing, and so which is going to is mortgage rate going to fall that much that the affordability is going to increase a lot, and at the same time, don't forget that we have liquidity which is being sucked out from the system by central banks also, taking away the money out of QT. Then Japanese monetary policy change, which conservatively, at least by April next year, it should come into a tightening mode, or yield curve control to be loosened a bit more, moving away from negative interest rate. This can trigger a market crisis. So I'm just trying to assess something which can trigger a market crisis, which will actually normalize the market expectations or the market valuations. That is what I'm looking at. We are definitely, I think, we're much closer to it than some time back. And the withdrawal of liquidity, as I have said, and so these events, like market event or a financial event, if it does happen this year, I think we can see the dollar push up sharply higher, particularly against the EMs, which are actually indebted in the dollar, the dollar commitments, or rather dollar borrowings. Then global liquidity, this is how it's been falling due to central bank absorbing not absorbing the matured securities which they have been buying through QE. So that's about. So expect something to happen which will correct the market excess, and we could have a bout of dollar strength. But underlying, or the structural view for me on the dollar is downside because of more because of a cyclical, structural factor as well as a cyclical factor. Dollar is underowned, particularly against the Japanese yen and perhaps against the euro also. EMs are more of a carry play, and that money comes and goes, so that is not a sustainable thing. Japanese yen and euro. China, as Gopi said, not this year. I think it has to wait for really showing up its strength. Then that's one thing. The other side of it is the bigger one for me is the US fiscal, bomb, which is much closer to being detonated now. The US fiscal deficit hit 1.7 trillion last year, or rather the fiscal year 2024 for them, and that's a 23% increase. And at 6.3% of deficit ratio, it's just equal to where Italy is right now, but the scale is much larger, US economy being much larger, and their their debt is about 33.7 trillion, and every 1% increase in the interest cost means that they have to shell out 337 billion more to finance this debt. So that is a big thing. So why this can be a headwind for the market, much bigger headwind than any market event, is because US continues to spend a lot. Whatever they have, many of the things that they have started to spend during COVID, they have been institutionalized, and they continue to spend much of them. None of the expenses they have been, they are going to cut. Healthcare or defense, none of them they can take back. And then it's an election year in US, and I think there are already reports that they are planning big spending, and so possibly Fed's pivot announcement yesterday has something to do with the fiscal plans of the government as well. And the yields are not going to come down that fast because of the huge supply of the paper that the government will be getting into. The fiscal situation is well reflected when you look at Moody's downgrading US credit outlook to negative from stable. And we have been hearing about the foreigners selling US treasuries as well, particularly when the yields were on the rise and the dollar was getting too strong against the yen and the Chinese yuan. So foreigners are not increasing their holdings. Yes, the de-dollarization move, they talk about which has started post the Russia-Ukraine war, where US has once again been seen using dollar as a weapon. So that has gained ground. That's the reason why, whenever you see rally in the dollar, you have many sellers. I have seen in the last few months, every data from Europe has been on the softer side, but the minor dips in the euro have really been bought into. And particularly when euro has a lower interest rate compared to US, that can only be explained by the fact that people are using those dips in the euro to diversify themselves. So what can US do to handle this fiscal issue is a few suggestions I have. I see them as a possibility, monetizing the debt by, which will bloat up the Fed balance sheet massively. It's already big. They are doing QT, but if when they have borrowed, see, around 6 trillion this year, and next year it is going to be even higher, and it's going to be a higher interest cost as well. So I'm not sure whether the given sentiment about the US debt situation, global central banks will be putting so much money into them. Local guys funds, and of course the Fed will have to take a major share of it. This is one possibility, and possibly they can. This is an extreme suggestion that they can probably get into yield curve control like Japan, so that the economy does not suffer because of the borrowing that the government does. And then of course they can devalue the dollar, make the dollar a little more attractive for foreigners to buy into and then invest into the US, and the money can start flowing in. Of course, this kind of devaluation of the dollar, I feel will benefit the gold much more. As we see, most of the currencies are inherently, relatively they may be going up and down, but then most of the currencies, because of the inflation, they have gone down in their value. And this is the fate of the fiat currencies, which are printed at will by the government and the central banks. And this is likely reflected in the value of gold, which is constantly going up. We have seen a massive rise of 15% in the last 2 months, from low of 1810 to 2100. And after correction, yesterday we have again seen it going up, 2.5% in one session after Fed pivot announced. I think my view on gold is very constructive, and as we get into more rate cuts across Europe, will do. UK perhaps late, will be later than Europe and US, but still they will do. Then I think gold is set to gain a lot. Technically speaking, 2070 had triple top, and then we had the breakout, but that was a false breakout. We came back under that, and now next time I feel when we break 2080, that I call it as a four top breakout in our technical parlance. When you go into 4 top breakout in a new territory, that's going to be a massive move. So all in all, I think dollar is definitely going to lose against the gold because of the reasons that I have stated, and also the fiscal issue that they are having. So that's my view. And as far as the other commodity, oil is concerned, I think we have seen a lot of volatility initially due to Ukraine war last in 22, and then in 23 due to Israel war. But that was very short-lived, and the consumption of oil has taken a hit. At the same time, the cohesion which we saw in OPEC plus countries all these years seems to have weakened. And this time there was no unanimity on the production cuts by the various members. It was left to voluntary, voluntary decision by the member countries. So that was one reason. Then US has been producing oil massively, and it's at record levels, their production right now. That's second factor. Third factor is US has loosened their sanctions on Venezuela, and also new find of reserves in Guyana region, billions of barrels, new reserves, and it's ongoing. In fact, many of the US companies are trying to invest in those drillings. So supply is suddenly a lot as far as the oil is concerned. I think this year oil will be subdued unless we have flare up in the Middle East again, supplies being affected. I think oil and with China not likely to bounce very strongly immediately. I think the oil prices are not set to sustain above 85 for any length of time, at least as far as this year is concerned. So I'm just finishing my perspective on the dollar on the long term. This is my study. I keep doing it quite often, and I have found that the dollar has cycle, up cycle and down cycle of 8 to 10 years. Sometimes it can be shorter, sometimes it can be longer. So starting with 85 is what I see a Plaza Accord, which then led to a big fall in the dollar. There was a concurrence among major countries to weaken the dollar, and then we had the dot-com bubble. Rather, we had the Asian financial crisis in the 90s, which led to buyback of the dollar. Then we had even the LTCM, long-term management company crisis, which led to a dollar, reversing the cycle. So every major crisis has seen the dollar cycles being reversed. And then dot-com bubble was a big one again, where US started to pivot their interest rates after the bubble burst, and then the interest rates fall in the US took it all the way down to 73 or thereabouts from 120 in the dollar index. That was a falling trend on the larger cycle, then bigger cycle, the latest cycle that we have seen, which I feel has ended starting in 2011 and ending in 2023 after the Ukraine war, rising from around 72 to 115. So that is my concern. I think now we have a fiscal crisis on our cards. I don't know when it will play out. Maybe they will keep things stable until the election, leave the bad job to be done by the new government. And then, of course, the inflation has already had its impact. So this might be starting point for the next dollar cycle on the downside. This is my surmise, and we'll see how it plays out. Thank you.
Got it, JK. Thank you so much for that exhaustive view on various markets. So a couple of follow-up questions. While I have a question for both of them, all of you can also put your questions. I already have one question in the chat box. I'll pick it up, and that's a view on euro dollar. Maybe one of you can take up. Before that, just one or 2 points. Both of you talked about a de-dollarization. Now, while we have a short to medium term view on dollar, especially against emerging market currencies and against the majors, but is this really a significant shift that we are talking about? When I say de-dollarization, both central bank diversifying reserves and even on the trade currencies between the regional, between the countries, we are seeing a regional currencies being used. Is this something which is really a mega trend? Just wanted, Mr. Gopi, your view on that. You did mention about that earlier.
I think it's exactly the same what I want to repeat. In the long term, I think de-dollarization is something which is definitely happening. And all this embargo, the sanctions, and putting the limits on what can be produced or bought from China is definitely working against the dollar. And we are already seeing a lot of trade happening between the Asian countries and between Russia and other countries, non-Europe and non-America. So clearly, settlements happening in the currencies other than euro and dollar. And also, if you see, I don't know the numbers, but I think China's exports now built in their currency, which is RMB, is shorter. And in fact, I think it has even exceeded the dollar, build exports. So these are making us feel that the de-dollarization process is started. And the other thing which Mr. Jayaram touched upon is the fiscal deficit. That is the biggest concern. So when have we seen the interest rate differential between Indian government bond and the US bond being so narrow? And yet you had the rupee being stable. Yeah, typically we would expect a rupee to crash. Okay, that's the case with all emerging currencies, but it is well behaved. In fact, if you see even the dollar EM bonds, they have been very narrow against the treasury, simply because there's so much of treasury being supplied. So this kind of a background, there's going to be pressure on the currency. Plus, you have seen central banks selling treasuries. China has been the biggest seller of dollar assets, basically the US treasuries, and they are replacing with gold. One of the reasons why gold also should go up. So, by and large, de-dollarization process has started. When it will completely happen, when it will completely become de-dollarized is anybody's guess. But more restrictions and more kind of sanctions coming in play, I think it could only accelerate the whole process.
Got it.
I think one more sanction by US on any other country, you get a big momentum on the de-dollarization.
Absolutely.
So that also highlights another point. See, I've seen this, some of our own clients, when they make payments in other currencies. For example, we know the cases of payment in Russian ruble in between. Now, we are seeing a huge transaction cost. Now, whenever we see this kind of an naturally, dollar did provide a lot of efficiency in the system and liquidity. When you go to the regional currencies, it will include some transaction cost, which is higher. That along with the other manufacturing that you talked about earlier, from a bipolar world to a multipolar world, all of that ultimately piles up the cost of operations. Will it not mean that inflation is here to stay? Will it not mean interest rates regime that we have seen for decades, a low interest rate, is also here to stay on a higher side? Just again, very broader view, but just again connecting various elements of cost and how will that lead to the world that we are going to enter into?
So maybe I will give it a shot and maybe after the Jayaram.
Please.
So I don't believe that we will have by multiple currency settlement happening. It is just a flux period. It's a period where people are trying to settle in other currencies other than dollars. This is the best way to settle it. Clearly, the cost of transaction has gone up. Simple. If you travel abroad as an individual, foreign currency, when you convert anything other than dollars, the margin in the exchange is very, very high. So clearly, that is what the exporter or importer will be facing. I think eventually that will settle down. It is a cost which will be there, but what is the cost, additional cost which the exporter or importer paying, the trade is paying, versus what is the benefit they are getting? That is what it has to be seen. So, for example, maybe with ruble, we probably ended up paying a little bit more from a ruble INR, arrived rate. Probably we paid slightly higher. However, the oil price itself was given a discount. So in general, the trade was profitable for India. Somewhere I read it was like a 2.5 billion per month kind of in 6 months, we gained 2.5 billion or something, just doing transactions with Russia. So I'm sure that such opportunities are there. And that is why, even though there's a transaction cost, people are ready to bear it. One is the cost of bearing transaction cost and the net benefit. Two is ability to even do a transaction. At times, if there's no way to do it, you're compelled to do it. But eventually, I think one or two currencies will become a dominant player. De-dollarization doesn't mean there'll be hundreds of currencies people will trade, like barter system. I think there'll be emerging, larger important currencies will emerge as future settlement currencies. Anybody can have a guess on it, but of course, China renminbi seems to be the easiest guess as we stand today.
Sure. And again, just to catch up on the interest rates, you talked about interest rate cuts, but again, looking at the way interest rate scenarios are going to emerge in the next several years, are we looking at remaining, the low interest rates of 0.5% and 1% is behind us? Is that really one we can expect in future?
Again, I can give my personal view. Maybe Mr. Jayaram can add. As I said, I'm expecting rate cuts globally, but it is not going to go back to the rates where we had 0% or 1%, right? Especially in the US and the other DMs, we had really low rates. And even in India, I'm not expecting it to go below 5.5 or so. So I think higher rates are here for some time. And that is because of large fiscal deficit, which will force, governments to raise money at higher rates. You can have the overnight rate wherever you want. You can put it at 0. But if the demand and supply is going to match at 5%, it's going to be at 5%. I remember in 2009, when after the initial, credit crisis, India went on a rate cut mode. And we had a huge fiscal deficit increase. The then finance minister increased the spend because we want to support the country. And we had a huge fiscal deficit. And then we have lower rates. And what happened? Interest rates on the bonds kept going. You kept cutting the overnight rates, but bond yields kept moving. Only the spread widened. Only because the demand and supply will reach at a price where there's equilibrium. You can do whatever you want to the overnight rates. So technically speaking, they can technically do whatever they want to the overnight rates, but the demand and supply will still remain at a higher rate. So it'll match at higher rate. So I think rates are going to be higher for some more time. The low zero rate regime is history for now.
Just to add a few things. So I think your question as to the higher inflation and higher interest rates staying above the record lows, two things have played out. I think we have seen the best of the globalization. We probably are more countries, including India, are looking at reshoring or onshoring of many of the things. That obviously that shift always involves higher cost because you are not optimizing on the cost differences. That's one thing. Second, most important thing, which I have been looking at constantly, is every central bank is more glued on to the wage inflation. Okay, the wage inflation is one of the biggest factor everywhere. you take UK or you take Europe or you take US or even Japan, everybody talks about wage. The wage inflation is here to stay. And that is something, that is the reason why you see the services inflation does not come down, even though, last inflation number from the US was okay. But if you look at the services side, the rentals, car rentals, and then the house rentals, they were all still again going up. So I think and if you look at country like UK, the Brexit-related shortage of labor is still playing out. So, and in the Japan, you have aging population. Perhaps India is best placed, but I think here also wage inflation. I think we recently had a settlement among the nationalized bank for 17% increase in their wages. Okay, that's a massive increase, and in an election year that has happened. So I think that these things will ensure that inflation does not go back to, I think we have seen the best of the inflation and best of the low interest rates, and that's not going to come back soon.
Maybe I just, maybe I have a slightly contradicting view on what Mr. Jayaram said, especially on the first part. Second part, I completely agree with him. Participation, in fact, participation is increasing, but not to the extent we saw before the pandemic. So clearly, inflation on the labor side is going to be a sticky problem. But on the onshoring bit, I'm not very sure that is happening everywhere. It's more political, and trying to talk to the audience, posturing. I doubt that will happen. So I believe strongly that the trade, as I said in the beginning, is like water will find its best efficient way. So currently it is in a situation where it's trying to find its best way, but eventually it will get out there. And I think the low cost production will move from, it's already moved from China to some of the South Asian countries and some of the Southeast Asian countries and some of the probably African countries also in future. High end will move to China. So there is a change in the players and the way they are playing. But eventually it will come to a situation where the efficiency will come into play. And then globalization is not changing in my view. However, on the labor front, I agree, and that could be a sticky point which could keep the inflation down, and apart from the fiscal deficit problem.
I want to pick the question from the chat box and also extend this session by a few more minutes. I wanted to touch upon a few aspects and then conclude the overall mega trend for the 2024. The question, and again related to that, is the European growth and the inflation and the view on currency. So Gopi, because you already talked about a low growth, but a stickiness of inflation, where do you see the currency, euro dollar, the range 2024?
So, I mean, I feel dollar is going to crash. Okay, and I'm with Jayaram on that. But my only worry is against euro and sterling. I think when it falls, obviously it will fall against everything. It's not going to escape. But I think it's going to be relatively underplayed against these currencies. So, for example, now it is at 109. And if we are going to look at the DXY dollar index falling by, let's say, 10% over the next 2 years, I think against euro, you're probably talking about something like 4 to 5%. It's because relative, when it falls by 10%, you will have an impact. But if you ask me, I think, I mean, the feeling I have is that probably euro is going to fall rather than dollar. And I would probably put my money in shorting euro at 109 than going long, in spite of having a weak dollar view.
From a business standpoint, Mr. Gopi, do you really see a worry for a European exporter?
Exporter into Europe? Exporter into Europe, I think there is definitely a worry because the growth is not there at all. I mean, the growth is really struggling there. And all these rate cuts would take time. Rate hikes is just blown in. So if they do rate cuts in 2024, we are talking about 2025 probably being a year where it could pick up. But 2024 is going to be a tough year for Europe. And people who are exporting into Europe obviously have to be worried.
And to US, while you said the growth continues to be the moderate, again from a business standpoint, not from the currency, but as a US exporter, do you see a change in the composition, or you continue to be the consumer-driven demand, and the business here exporting to the country seems to be reasonably doing well, or are you seeing a shift in the trend?
I think we will continue to export in the US. As I said, probably we'll export things, slightly different things, because some of the manufacturing will come to India also. We are doing some mobile we call it manufacturing, but we do some small work on mobile and we export. Yeah, job work. So such things. So basically, the composition of exports could change, but exports to US and US being the largest importer from us is going to stay there. So I don't see that part being impacted too much because I'm not too negative on the US growth story.
Got it. And also touching upon your first remark that you talked about China, wherein China is consciously shifting and going value. I mean, in terms of the export, it's going up the value chain. Does it mean anything as far as the Indian manufacturer or exporter or importer is concerned in terms of the competitiveness, in terms of the service exports? Will they get into? I mean, I'm just trying to put certain scenario again as a trend for the 2024.
Fortunately, we don't overlap with them. Whatever we think we have won from them is basically given by them, in my view. That's the case with every Asian country. So they're just letting go some businesses. And happily, we are grabbing it. Vietnam is grabbing manufacturing. We are grabbing some of the slightly better looking manufacturing part. India will be the service hub, India and Philippines from Asia, but India will be far ahead of all the countries in services. Unfortunate part in services is it is also co-linked with the manufacturing part. So we need to grow in manufacturing also to continue to be, in exports also to continue to be relevant in the services space. And services can only, can only give this much employment. So my worry is export as a business for India is going to struggle, whether it is products or services. Services definitely better than products, but still we are not, we can't claim that we are big in trade globally. We are net importers and will continue to be net importers.
Sure. As I put this question in an extended time frame, feel free to put up your question in a chat box. I have a few more questions for Jayaram before we end the session. Jayaram, I'm going to pick one point that you mentioned about the risk off. While you said overall dollar will be a weak, but there could be a risk off scenario, there could be a stress, and you showed that delinquencies and housing pressure and all of that, because of which dollar can strengthen. Now, and then when I look at, again, a crystal ball gazing, are you really seeing a risk which one needs to be worried about as you enter? Any major risk, or it's going to be business as usual?
I think we have been seeing some of these factors for quite some time now, like the leading indicators or the housing problems, even banking issues have been there for some time. There's not been a trigger for any such crisis to happen. I don't know from where it will come. I see the biggest risk is probably from Japan normalizing their policy, because there is a massive amount of carry trade lying there from every part of the world. Okay, take India, take US, anywhere. So that probably could be, that is the reason why Japanese are so very sensitive, that even though if they say that they want weak yen to be arrested, if it sharply appreciate, they somehow they come and announce some bond buying program or something or the other. So they are also aware of the risk of a very sharp appreciation in there. But I would definitely look at Japanese monetary policy as one of the triggers for that. That's something that I will keep a close watch
on. So somehow there seems to be some problem with my speaker. I'm not able to hear you, Jayaram, but am I audible?
Yeah, you are very much audible.
Okay, good. So I still can't hear your response, but I think we have anyway extended the time. And if you can hear me, I think I'm just going to sum up very briefly the mega.
Maulik, I just have one
Jayaram,
question.
yes, you want to see it? Please go ahead. I can't hear you, but please go ahead.
I just have one question to Gopi. Where do you see Indian yields going? Because we are expecting a lot of money into the bonds next year, and already interest has started. We have seen good inflows for the bonds also. So where do you see Indian yields going by end of 2024?
Yeah, it's a difficult question. Well, central government is clearly reducing the deficit, and the supply is going to be stable because absolute number is not going to fall. The state government supply is increased. Okay. So to that extent, one way to look at it is maybe the credit spreads, the state versus central government spread could widen. So just to answer where Indian government securities will go, I think it is going to be rangy with rate cuts and all expectations. I think 10-year would probably will be around 7% on the lower side, okay. But I don't see it reaching 7.5 at all. So you're going to have another stable year of interest rates, even in bonds. This is assuming there is bond flows and stuff that is coming. In spite of that, So I don't see any major fall in yields in spite of rate cuts and also flows, because it's all priced in by and large.
Okay. Thank you. Maulik.
So Jayaramji, if you can hear me and if you can help conclude the session, somehow I can't hear both of you. There's some technical glitch. Why don't you just sum up the session for the participants and then we can close?
Yes.
I can't hear both of you. But
yes.
anyway, okay, let me do one thing. I will sum up whatever I've gathered, leave it to you, and then you can end the session. The way I see it, the major trend emerging is, I think both of you agreed about, or rather there is a consensus about dollar index being lower or dollar being weak as a currency against emerging market currency, and maybe against majors, probably not as weak as against the emerging market. Of course, rupee has a different challenge. We are not sure whether rupee will participate, and that too again what extent, looking at the way RBI is intervening. And that's where, though dollar index may be weak, and as Mr. Gopi said, maybe to the extent of 10%, but probably rupee range when he gave it was 82.5 and 84, which is not even 1.5–2%. So rupee participation again continues with a question mark, but dollar in general is weak. There could be an risk generally in the system which could lead to a dollar strength temporary, but by and large we are looking at a weaker dollar. Broadly, the growth momentum is in place. Inflation may not be that worrisome, and therefore the interest rates may be favorable from a business standpoint. And as far as India macros are concerned, pretty strong, and that can continue to be strong. And maybe with 2024 as the new elections and the stable government, I think India probably continues to be stable on macro front, plus the internal, the stability of the government. So those are the things which can work in favor of India. Currency, specifically rupee, stable, not really seeing us panic. Commodity, Jayaramji, you mentioned about gold being strong, and that will probably all the other commodity may also benefit. And you covered about the crude as well. I mean, this is all broadly I pick up. There's one last question: why is RBI keeping rupee in a tight range? If one of you want to respond, maybe we'll end in 3 minutes at 6:15. Though I can't hear, please respond and also conclude, Jayaramji, on behalf of Almas. Over to you.
Yeah, as I think definitely there's no easy explanation for what RBI has been doing, and we have not seen this type of action from RBI. There was a report in a paper also saying market men are baffled by the way RBI has been operating. The only definitely upside they are capping because of inflation concerns, because our inflation is very volatile. Every up and down move in the food prices already affect our inflation. I think inflation is one of the concerns, and also giving a sense of stability to the global investor also, who are looking to put a lot of money into Indian bonds. These are the two things that can be actually keeping the rupee upside cap. At the same time, probably they are also building their rebuilding their reserves, as Gopi shared. Actually, though the headline number of reserves is at 604, if you eliminate the forwards, it will be somewhere around 590 billion. They would probably like to rebuild their reserves. And I think probably when we get chunky flows for FDIs or the bond market, that's when probably we can expect some relaxation in the RBI's stance on the currency. And unless we see, like I hinted, if there can be a currency crisis, rupee can go, the global financial crisis or market crisis, we can actually go towards 84. That's the best I see. And on the downside, probably the best I can see is around 82 levels. But for the time being, I don't see a strong reason for, after holding it for such a long time in a tight range, there needs to be a very strong reason also for RBI to let it move big on either side. So I think this situation is going to continue, and the fact that Fed is pivoting is only stronger reason for rupee not to depreciate immediately. So that's our view. And now to sum it up, I think we have had a very good participation. Gopi, thank you very much. Really. To give a very good overview of all the economies and what we can look forward to from these economies affecting the rupee, affecting the overall dollar, and also how the flows are going to be. So, and particularly on the China, what you said about China, shifting from the smaller sector into the capital goods sector and automobiles, etc. That's a real good input. That so China is your perspective that China looks at longer perspectives of several decades rather than next next 5 years, 10 years, and that's a really good perspective. So we understand that Chinese are not really worried about the slowdown that they are currently facing. So it's a good. Thank you for giving all that perspective, and I thank all the participants who have stayed, though we extended by nearly 15 minutes, and we will come back with one more webinar in the next month. We'll announce the subject for that very soon. And thank you once again for participating. Thank you, Gopi. Thank you, Maulik, for being a wonderful host. Thank you.
Thank you, Jayaram. Thank you, Maulik. Thanks, Almas. Thanks, everyone.